They never told you this exists. That reversal you just saw, no indicator predicted it. No sport level was drawn there, no niche event caused it. And yet, price hit the exact point and reversed like it was magnetically pulled. That's not random. That is a HIPPO, a hidden interbank price point objective. And it is one of the most closely guarded concepts in professional forex trading because it reveals exactly where the banks are targeting price to go. By the end of this video, you will know what a HIPPO is, why it exists, how banks use it, and how to find it on any chart in any time frame right now. Here's what nobody tells you when you start trading. The forex market is not a fair playing field. On one side, you have retail traders armed with RSI, MACD, Fibonacci, support and resistance, watching the same charts, reading the same news, taking the same trades as every other retail trader on earth. On the other side, you have the interbank market. There are the institutions that actually move price: JP Morgan, Citibank, Deutsche Bank, HSBC. They account for over 70% of daily forex volume. They are not using RSI. They are not drawing the same support lines you are. They have one thing retail traders don't have: order flow data. They can see where the liquidity pools are sitting. They can see the cluster of stop losses sitting above last week's high. They can see exactly where retail traders are positioned, and they use the information to hunt price towards specific levels that clear liquidity, fill their massive institutional orders, and set up the real move. Those target levels are HIPPOs. This isn't conspiracy theory. This is the mechanical reality of how market with massive institutional participants actually works. And once you understand it, you'll never look at a price chart the same way again. HIPPO stands for Hidden Interbank Price Point Objective. Let's break that down word by word. Hidden, because it's not visible on standard retail chart. It doesn't appear as support line, a pivot, or an indicator signal. It lives in the interbank order book, which retail trader cannot see. Interbank, because it's generated by the activity between major banks. When banks need to fill large currency orders, they need liquidity. They find that liquidity at specific price points where opposing orders are clustered. Price point, a precise level, not a zone, not an area, a number, often a round number, a psychological level, or a previous swing high or a low that holds a concentration of stop orders. Objective, because it's a target. The bank's algorithm, trader, or dealing desk is actively steering price toward this point to fill orders, clear stops, and establish position. Think of it this way: a bank needs to fill a $500 million buy order on Euro USD. To fill that order, they need sellers on the other side. Where are the sellers clustered? Below a key swing low, where retail traders place their stop losses, at a round number, where retail traders sell at psychological levels. So the bank engineers price down to that level. Retail stops get triggered. Retail traders sell. The bank fills its $500 million buy order against all the retail selling. Then price reverses sharply upward. The retail traders think they got stopped out by the bad luck. What actually happened? They were the liquidity the bank needed. There are three primary types of HIPPO levels you need to learn to identify. Type 1: Round number liquidity pools. The most obvious HIPPO locations are round numbers: 1.2000 on Euro USD, 1.3000 on GBP USD, 150.00 on USD JPY. Human psychology causes a massive concentration of limit orders, stop losses, and take profits to cluster at these levels. Banks know this. They actively target round numbers because that's where the deepest liquidity sits. When price approaches a major round number, it is almost never a coincidence. Type 2: Equal highs and equal lows. When price makes two or more highs at almost exactly the same level, or two lows at almost exactly the same level, that is a flashing signal of a HIPPO. Here's why. Every retail trader who sees equal highs thinks strong resistance. I'll sell there. They pile their sell orders at that level. They place their stop losses just above it. The bank sees the concentration of orders and it sends price just above those equal highs, triggering all the retail sell stops, collecting all the liquidity, then reversing price sharply down. The retail trader got stopped out at the top of the move. The bank just got its entry. Type 3: Previous session highs and lows. The previous day's highs and low. The previous week's high and low. These are HIPPOs because every major institution monitors them. They are programmed into every bank's trading algorithm as key reference levels. Liquidity builds above the previous day's high all day long. Retail traders placing breakout orders, buy stops, take profits. Bank target that liquidity before the real institutional move begins. This is why you so often see price spike above yesterday's high in the London session, only to reverse and spend the rest of the day grinding lower. That spike wasn't a breakout, that was a hippo being harvested. Now, the most important question: how do you actually trade this? I'm going to give you the exact framework I use. 3 steps, no indicators required. Step 1: Identify the nearest hippo level to current price. Look for major round numbers within 50, 100 pips of price. Look for equal highs or equal lows on the 4-hour or a daily chart. Look for the previous day's high and previous day's low. Mark them all. You now have your map of where banks are likely targeting. Step 2: Wait for the price to reach that level and overshoot. The keyword is overshoot. A hippo doesn't just tag the level and reverse, it spikes through it, takes out the stops sitting just beyond, and then wicks back. That wick, that spike, and immediate rejection is the bank completing its liquidity grab. It is your entry signal. Step 3: Enter on confirmation, not anticipation. Do not try to pick the exact top or bottom of the wick. Wait for the candle to close back on the other side of the hippo level. Then enter the next candle open. Your stop loss goes beyond the wick, not the level, the wick. Your target is the next hippo level in the direction of your trade. Risk to reward should be a minimum of 1 into 3. If it isn't, don't take the trade. 3 steps: no RSI divergence, no MACD crossover, no Fibonacci retracement, just price, liquidity, and understanding of where banks need to go. The hippo is not pair specific, it's not time frame specific, it's a market structure phenomenon, and it repeats because human psychology and institutional mechanics repeat. Before you go trade this, 3 mistakes I see constantly. Mistake 1: Entering before the wick forms. You see price approaching the round number and you jump in early. Price blows through your entry, takes your stops, then does exactly what you predicted from a level 30 pips below where you entered. Wait for the wick, wait for the close, then enter. Mistake 2: Using hippos in isolation. A HIPPO works best when it aligns with the higher time frame trend, a key structure level, and a session transition. London Open, New York Open. A round number at the low of a downtrend hit the London Open with equal lows just below it. That is a high probability setup. A round number in the middle of a ranging market on Tuesday afternoon with no confluence. Skip it. Mistake 3. Ignoring the spread. HIPPO wicks are often 5 to 15 pips. If you are trading on a broker with a 3 pips spread, your stop gets eaten by the spread before the trade even starts. Use a tight spread ECN broker for this strategy. If your spread is wider than 1.5 pips on majors, find a new broker. That's the HIPPO framework complete. Round number liquidity pools, equal highs and equal lows, previous session highs and lows, wait for the shoot, wait for the wick, enter confirmation, target the next HIPPO. 2 questions for the comments. Drop your answer below. First, had you heard of HIPPOs before this video? Second, which of the three types do you see most often on the pairs you trade? I read every comment. I reply to ones that ask good questions. If this changed, you see a price chart, hit the like button. Seriously, most people who found this video through search will see it again unless the algorithm pushes it. The like button is how that happens. 2 more videos right here. One on liquidity hunting, one on how banks actually manipulate price before major moves. Watch those next. They complete the picture. I'll see you there.